Welcome back guys to another Zero DTE video, and today Ernie's going to be talking about the nature of our strategy, so make sure you stay tuned. If you're interested in becoming a pro trader, check out the link in the description where you can find Ernie's education platform. Enjoy guys.
So if you have a butterfly that's out of the money, out here somewhere, this represents its debit, and price is out here. There's a certain number of prices that are going to go away from the butterfly. Let's say it's 50% go away and 50% go towards the butterfly. Now, being out of money and having that risk to reward setup, there's going to be a certain percentage of them that will make small profits. So let's say that the profit curve goes like this as you get closer to the butterfly. And then if you get into the butterfly, it starts moving up and shooting up almost exponentially, because of the nature of the butterfly and how it's constructed. Yet the risk on the other side is always fixed. It is fixed and it's very small. So the percentage of time that you're going to go up into the butterfly's profit tent is going to really be part of a normal distribution. And in fact, I did a normal distribution study looking at about 20 years of data. Let me bring that on, all right? And so we can look at this as sort of an inverse trip to the butterfly, where the red line here represents the zero line, and anything to the left is going to be a loss, as an example. And that's fine, because those losses will always be fixed. So it doesn't matter how big of a move it goes to the left, it's always going to be fixed. However, on the profit side, the extent of that move is going to affect the amount of profitability dramatically. As a matter of fact, as we go further out into these outlier moves, the amount of profit that gets returned from the butterfly is going to increase almost geometrically. And I can demonstrate that by showing you the actual distribution of returns on the butterfly. Well, on this strategy, a zero DTE strategy. So here's the distribution of returns. So as you can see, it's almost an exact correlation to the distribution of moves in the S&P. In fact, that's what I was just showing you here, the distribution of moves in the S&P right here. So these moves that move out here start making way, way more money, while these moves make a lot of small money. But these small money moves pretty much capture all of the negative moves. And then so what we're left with that actually builds the trading account are all these medium to outlier moves, which are going to happen no matter what. All we have to do is be there to be able to manage our profit-taking strategy. So this is the distribution of returns. Now you can see some returns as high as $2,300 for a risk that averages around $200. But these losses are capped. They never get bigger than that. So all of these moves in here tend to offset all of these negative moves. Then what you're left with are these outliers that will happen no matter what, and they will propel your account. And that's exactly what happens here. Now, it's an interesting behavior that happens. It's kind of a sidestep behavior. One of our tenets is that we preserve capital first and then make profit second, because we are under the understanding that we can't force a trade. We can't force a big win. Most of our wins, maybe 70 to 80% of them, are going to be small. Now, when I say small, that means some multiple of the risk that we take. So if our risk is 1x, 70 or 80% of our wins are going to be averaging around 1.5x. So you can see that 1.5x definitely will offset all of the losses. So what's left over then are the other moves, and they average anywhere from 1.5x to 10x of the risk that we take. But most of the time, we're moving sideways, these small and medium-sized wins, and then we get some big wins. Then move sideways, get a big win. Move sideways, get a bigger win, and so forth. And then once we start adding a little size to it, you start seeing a little bit more volatility, and then some of these really, really big wins that happen, and then sideways moves, and then big wins, and sideways move. And this is going to continue to happen with regularity, but as we increase our capital, then we increase our position size commensurate with the size of that capital. Then those wins are going to get bigger and bigger, and therefore compound the rate at which we start making money. So that's the nature of this strategy.
Thanks for watching guys. I hope you enjoyed the video, and if you did, make sure you hit that subscribe button and hit the like button below. If there's any questions that you might have for Coach Ernie, make sure you leave them in the comment section. Thanks guys.